Welcome to PPP, What's the New Path, presented by FEI Twin Cities Chapter. Thank you for joining us today. Before we get started, we would like to share some information regarding CPE credits with you, and we appreciate your patience. Today's webinar is worth 1 continuing professional education credit. To be eligible for CPE credit, you must answer at least 3 of the 4 polling questions on the slide screen during the webinar and have a total viewing time of at least 50 minutes. Participants will have the opportunity to download their CPE certificate immediately following the webinar if the above requirements are met. In accordance with the standards for the National Registry of CPE sponsors, CPE credit will be granted based on a 50-minute hour. We are unable to grant CPE credit in cases where technical difficulties disqualify eligibility. CPE program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements listed above. I encourage you to download today's presentation, which is located in the Resources widget on the lower right-hand side of the screen. After the presentation, this webinar will be available on the FEI member site where you can replay and download. After the conclusion of the webinar, your CPE certificate will be available in the Certification widget and will also be emailed within 24 hours should you meet the criteria. Below the Speaker Biography widget is the Q&A box. Please feel free to ask questions throughout the presentation, and the speakers will answer as many questions as possible. It's now FEI's pleasure to introduce our speakers for today, Tom Hodnefield and Paul Longsdorf. Gentlemen.
Thank you, and thanks for everyone who is attending today's call. I'm Tom Hodnefield, and as mentioned, joining me is Paul Longsdorf. We are both with Redpath and Company, CPAs. We're both partners and have been here a long time, more so than I can count. Paul brings a tax background to the conversation. I have audit and accounting, but we're both client managers. And at our firm, that means, among other things, we both have spent a lot of time digesting the PPP and related issues and spending a lot of time with clients discussing it as well. And starting with the crazy time back in late March, early April, where I think we both spent probably 2 weeks straight on phone calls and Zooms. But the good news is a lot of that uncertainty and confusion at that time has been clarified or alleviated through recent action. So what we're going to cover today is listed here, and the deck we prepared was originally, or I guess the most recent version was back in June, shortly after the Flexibility Act was issued, and there was a lot of new topics there, and a lot of that merits at least a brief overview, and we'll cover that. But we've also updated the deck for some more recent guidance, and then just more recent conversations that have come up, and the most common questions we're fielding from clients and others as well. So we'll start with the PPP overview. At this point, we're assuming everyone on the call, or at least most people on the call, probably have at least a working knowledge of the PPP and how it works and so forth. So we're not intended to get down in the weeds on the detailed calcs, although we certainly will have should have time at the end for questions or comments thereon. But we will talk about recent developments, including the recently issued FAQ back in early August. There's been some accounting clarifications. That's the third bullet there, accounting considerations. And then embedded throughout the presentation, we'll talk about what we know and what we don't know, or more, I guess, more to the point, what is unknown, and hopefully will be determined, but we shall see. And then lastly, next steps, not only what may transpire at the federal level, looking into the crystal ball, but also what you can and perhaps should be doing at this time. And I believe that will lead us into our first polling question. You can see these are not hard questions. And as a reminder, you do have to reply to these to get your CPE credit, and you do have to hit the submit button. So please reply, hit the submit, and then we'll wait about 20-30 seconds for the data to populate. And the first question, very simple. Do you anticipate your loan to be fully forgiven? So please reply and hit submit, and we'll give it just a little bit of time here for it to populate. While we wait for that, I can say one nice thing about the presentation, and my virtual background doesn't work, so it did allow me to clean off my desk in the background. First time that's happened in months, so I appreciate that. I think we're probably ready to move forward. So let's see what the reply is. 71% anticipate full forgiveness. Paul, what are your thoughts?
Well, I would have expected it to be most of the people, and be interesting as we go through the presentation and maybe field some questions. Quite honestly, on the ones who don't expect full forgiveness, where they believe they're going to run into issues.
Yeah, I agree. I think in conversations I've had with folks since the Flexibility Act came out and made it more favorable, that's what we're hearing is the majority and maybe the overwhelming majority may qualify for full forgiveness. So perhaps those of you in the 28.6% in the no bucket, maybe by the end of the presentation here, maybe that number will decrease. That would be nice, wouldn't it? Okay, yes. So I'll move forward. Listed here are just some of the common questions. Now, we have this slide duplicated at the end of the presentation, so we're not going to answer them here. You can take a look at the screen there to see what they are. And these were common questions that we either heard starting a few months ago or more recently as well. I will point out maybe one of the biggest ones we get now is number 4. When can I apply for forgiveness? And we should add on to that. It's probably the more common question nowadays is when should I apply for forgiveness? And spoiler alert, the answer we're going to have is for many organizations, we're recommending a wait and see approach on that topic. So again, we'll revisit those at the tail end. And as you have questions, please do type them in, and we'll cover what we can at the end of the presentation. Okay, and with that, I'll turn it over to Paul.
All right, thanks, Tom. And so, as Tom mentioned, first we're just going to kind of go through, sort of what the milestones have been. And if everybody remembers what seems like 5 years ago, back on March 27th, round 1 of the funding for the PPP was passed, authorizing $349 billion in loans. And many of you, almost all of our clients, spent the next 2 weeks to 4 weeks applying for their loans to make sure that they would get funding if they had a need for that. And consequently, toward the end of April, those funds were just about gone, and Congress authorized another $310 billion in loans on April 27th. August 28th, the PPP loan application period ended, or August 8th, rather, I'm sorry. That period ended. There is still somewhere in excess, I believe, of $100 billion in funds that were not expended in that process. So one of the questions is, will they open that back up again? And we'll see that's open. On June 5th, as the PPP Flexibility Act was signed into law, and we've got quite a bit in here on sort of the changes that happened with that Flexibility Act, which I would say, 99.9%, if not 100% of those changes were positive in terms of taxpayers being able to receive full or increased forgiveness on their loans. Also then on June 16th, the new forgiveness application was issued, and that application then took into account the changes from the Flexibility Act. And then August 4th was the most recent FAQ that was issued that, again, answered more of the forgiveness questions. So the rules around forgiveness, definitely there's still some open items, and we'll talk about those. So they're still changing, but they're definitely getting much closer to having everything on the one hand, and I guess on the second hand, just with the flexibility that was created from the Flexibility Act in forgiveness, some of those rules, and may be less of an issue simply because taxpayers will have an easier time getting forgiveness, regardless of how you interpret some of those items. Keep in mind as you go through the forgiveness process, and I can't emphasize this enough, but ultimately, you're going to interpret the application. You may talk to your CPA, your attorneys regarding the forgiveness application. Ultimately, you're going to submit that application to your bank that where you received your loan. They're going to approve it, and they're going to submit it to SBA. So if you are unsure at all about any items in your application, I just strongly encourage you to have an open dialogue with your bank, and so that when you submit that application for forgiveness, there are no surprises there, and hopefully that passes through without issue. First, we're going to start with a few of the changes, favorable changes that happened in the Flexibility Act. The first one, if you're going to get your loan fully forgiven, is quite honestly not much of an issue. But the loan period in the Flexibility Act was extended from 2 years in the initial act to 5 years. And that means that any loan that occurred after June 4th now has a 5-year term. And just remember that if you got your loan before that time period, you signed loan documents where that loan had a 2-year term. So, the legislation can't change those. If you believe you're going to have a loan out there and, after forgiveness and you would like to have a 5-year period, you need to go talk to your bank and see if you can negotiate an extension on that. The interest rate on those loans remains at 1%, whether it be 2 years or 5 years. The deferral period for making loan payments changed. Initially in the CARES Act, it was 6 months. So it was 6 months from the date of your loan, you could defer payments. And so at that time, that meant that everybody was kind of thinking, hey, you're going to be applying for forgiveness within 6 months of your loan, because you don't want to start making payments. Well, the Flexibility Act kind of flipped that on its head, because, now you've got number one, you've got up to a 24-week period to accumulate your expenses, but you also have a deferral period that is 10 months, goes to 10 months after the end of your forgiveness period. So let's talk about an 8-week forgiveness period. If we're under the old rules and we're sticking with the 8 weeks, if we got a loan in early April and say our 8-week period ends in the end of May, that 10-month period then ends, toward the end of March of 2021. So quite a bit longer than that original 6-month period from the date of the loan. Interest does accrue during that deferral period, but remember that if you get to the extent you get your loan forgiven, you're also going to get that interest forgiven. So if any portion of the loan that's not forgiven, the interest that accrued on that, you would owe. But if your loan is fully forgiven, the interest will be fully forgiven as well. And that change is retroactive. So I alluded to the 8-week forgiveness period, and that 10 months applies whether you use the 8-week period or the 24-week period. So as I've already alluded to, that the 8-week period was extended to 24 weeks. So that, originally you had 8 weeks essentially to accumulate payroll and other qualifying expenses to arrive at your forgiveness amounts. Extending that to 24 weeks, really in most cases, I think is going to allow most taxpayers to achieve full forgiveness, on their loans, unless they really just, had a catastrophic situation, in terms of their payroll and so forth. But I think thinking about, Minnesota, where we had, restaurants and bars and so forth were forced to close. Some of them have not been able to reopen, and that's certainly an issue there. But those that have been able to reopen, I think by and large, with a 24-week period, will still be able to achieve forgiveness on their loans. And then that covered period. So it's going to be 24 weeks or it ends on December 31st. So if I actually got a loan on August 8th, I would not get the full 24 weeks because my covered period would end on December 31st. And if I had my loan prior to June 5th, again, I can either use the 8-week or 24-week period. The question comes up: can I use a forgiveness period other than 8 or 24 weeks? And technically, the answer is no. I'm in one of those two scenarios. But there is an ability to apply for forgiveness prior to achieving a full 8 weeks or prior to achieving a full 24 weeks. There are some nuances to that are still unknown in terms of FTE limitation calculations and those types of things, which we'll get into as well. Okay, our next polling question. When do you plan to submit for forgiveness? So do you expect to submit here in the third quarter of 2020? Do you expect to submit in the fourth quarter of 2020? Do you expect to submit in 2020-21? Or are you just going to wait and see and wait for additional guidance? And again, we'll hold on for 20 seconds or so for everyone to submit their answer. I'll submit mine so I get counted in the numbers as well. This will be an interesting one, I think. All right. The question shouldn't be too hard, so I'm going to go ahead and jump forward, and hopefully everyone got a chance to get in. All right, so we've got 18% in Q3, so those people are all working on their applications as we speak, I think. 13% in Q4, 9% in 2021, and 59%, the vast majority, are taking a wait and see approach, it looks like. And that's interesting, and we'll talk about scenarios where it may make sense to go ahead and try and get that application in early, and also reasons why it may make sense to wait.
Yeah, and Paul, that's really consistent with what we've been advising clients as well. And I mentioned before, we are advising most entities to take a wait and see, and there certainly are reasons to not wait and see, but for most people, I think that is the right bucket.
Yeah, and as I said, we'll get into some reasons there, taxability reasons and other things. So as we mentioned, there was a new forgiveness application issued on June 17th, and that application clarified a really important point that we were unsure of until that point in time. And that is, as we mentioned, there are potential reductions in how much of your loan you can get forgiven if you've reduced your full-time equivalents or if you have reduced wages and salaries for individuals more than 25% during the covered period. And the application made clear that those reductions apply to the expenses incurred in the covered period and not the loan amount. And that's a really big deal, because obviously if they applied at the loan amount, then if you had any reductions at all, obviously you're not going to receive full forgiveness. Now, if you start to look and say, hey, I was able to operate, even at close to the levels that you were operating prior to the covered period, or in your base period, you now have potentially a 24-week period, compared to a much shorter period that the loan amount was calculated on to begin with. And so even after applying those reductions, you're very, very likely to be able to receive full forgiveness. The other thing is that remember that not all your loan amount was all calculated based on payroll. Your forgiveness amount is payroll as well as other expenses. So the 24-week applicable wage cap is now $46,154. So that's based on $100,000 of annual wages. For owners, that cap is slightly lower, and I actually have that a little later, so we'll talk about that then. And the 8-week cap is $15,385. So we can see obviously a significant difference, 3 times higher cap there to potentially be able to capture more wages and have a larger forgiveness.
And Paul, before you go on, I'd just like to say those first 2 bullets that were on that last slide, I mean, that was huge. Those were the game changers. By both allowing the period to go to 24 weeks and clarifying that the potential knockdowns are based on the gross expenses rather than being capped at the loan. Those 2 combined are why I think the majority, and maybe the vast majority of entities should be able to get full loan forgiveness. Yeah,
I definitely agree. So when that new application was issued, they also issued, under much pressure, an easy form. Everybody loves the thought of an easy form, and so Congress was pushing for that because obviously some of these calculations are difficult. How much that helps, we'll talk about a little bit, but there are really 3 scenarios when you can use that easy form. The first is pretty straightforward. If you're a self-employed individual, / independent contractor, and you have no employees included in your loan. In other words, your loan was entirely based on your Schedule C income from 2019. You are automatically allowed to use that easy form. And in fact, the SBA is asking you to please use that form. And I'm sure that obviously makes it more simple on everyone's side to do that. The next 2 options are a little more complicated and quite honestly come down to, do I meet exceptions to these reduction tests that allow me to not take the reduction? So, kind of editorial comment, to me that means you really need to go through the steps in the main application to determine whether you have these reductions or not, before you can figure out if you can use the easy form. So, you kind of have to go through that process either way. And then if you meet those exceptions, if you want to use the easy form, you can, but you're still going to need to provide, the information as to why you meet those exceptions, to the bank who, ultimately would apply, provide that to the SBA. So in my mind, doesn't necessarily really reduce the work burden. But what the exceptions are is, if I don't have any greater than 25% annual employee wage reductions, and I have no reduction in employees or average paid hours, between January 1, 2020 and the end of the covered period. So that's one. And the second is if I have no greater than 25% annual salary or hourly wage reductions, and I was unable to operate during the covered period at pre-February 15 levels due to compliance with, actually this says CVC, should be CDC or OSHA or the Housing and Services. And that's an interesting one, because when that first came out, the first thing I thought of again was our, bars and restaurants here in Minnesota that of course were required to shut down, as well as many other businesses due to the governor's stay-at-home orders. And of course, you look at this and say, well, wait a minute, I don't see in here the state government or the governor shut down applying there. On June 26th, importantly, in an interim federal final rule, the SBA issued and said they intend to interpret that very broadly, and if because they know that the state governments, the state and local governments were where most of these shutdowns came from, if that was done under guidance from the CDC and OSHA and so forth, then they will interpret that you qualify under that exception. So I think for purposes of this item here, I think it means your Minnesota bars and restaurants, as well as obviously a lot of other locations and other businesses should be able to qualify there. So few considerations, on that 8 versus 24 week period, and Tom, certainly feel free to jump in here, but if you can receive full forgiveness just based on your wages and other expenses through the 8 week period, certainly now you look and say, okay, well, that's certainly an option to use the 8 week period as opposed to the 24 week period. In most cases, I would say if you're not receiving full forgiveness in the 8 week period, why not go to the 24 week period? But there certainly could be situations where it can be advantageous. You certainly want to look at the FTE forgiveness reductions and the 25% wage reductions to determine, just what at what point you can receive full forgiveness. Remember that you can apply at any time, and so you can apply before your 8 week period is over if you've already achieved all those expenses, or you can apply before the 24 week period if you determine that makes sense for your business.
Paul, yeah, I can jump in and just, in fact, I was on the phone with a client this morning that had that question between 8 and 24 week period. And one thing, if you're able to take a wait and see approach, keep in mind, you don't have to make that determination, whether it's 8 or 24 until a little down the road.
Exactly. If you think about the example I used earlier on an 8 week period, starting in early April that ends at the end of May, that's using the 8 week period, and that gets me out until the end of March of 2021 with my 10-month window to apply. So obviously the 24-week period would end 16 weeks later than that. So I definitely have time to make that determination. And in fact, I can literally apply anytime, up until my loan comes due. I'm just going to have to start making payments on the loan once that 10-month period is over.
Yeah, and I think in the conversations I've had, the entities where it might make sense, other than personal preference, but where it might make sense strategically in between the 8 and the 24 week, might be as if your organization may have furloughs or layoffs in the near term, and you want to get that application in, and you wouldn't still qualify for 100% forgiveness anyway. As we mentioned, even with reductions, a lot of organizations will still qualify for 100%. Right. But those are the conversations I've had, Paul.
Yeah. Yep. Exactly. So what Tom's alluding to there is, let's say, for example, I went into my 8-week period, I got my loan, and I was able to operate, at full capacity. I've got my payroll, I've got my expenses, I can achieve full forgiveness. But, maybe I'm a construction contractor and I basically, in that 8-week period, I pretty much burned through my backlog, and now I'm going to have to start laying people off. It may make sense for me to say, all right, then I don't have to rely on the safe harbor. During that 8-week period, I did not have reductions. And so I can go ahead and apply, and now I can go lay people off, and it doesn't cause me any issues. Whoop, jumped ahead there, sorry. So under the CARES Act, right, there were, reductions in the loan forgiveness based on FTEs and wage reductions. And the Flexibility Act didn't change that, merely clarified a few things there. It did change. We've alluded to this safe harbor date, right? At what point? So there was a safe harbor in the original act that said, okay, maybe I've reduced my FTEs, maybe I've reduced some people's wages, but if I restored those by June 30th, then I didn't have to have these reductions. The Flexibility Act took out June 30th and made that December 31st. So that's interesting, right? Is it didn't give me the option. It took out June 30th. So I can no longer say, okay, great, I took care of everything by June 30th. I'm good to go. If I'm relying on the safe harbor, now I'm out to December 31st, 2020, which may mean, if I'm relying on that safe harbor, that I can't apply for forgiveness until 2021, right? Because I don't know what my FTEs on December 31st, 2020 are going to be, or what my employees' wages are going to be. So I've got to wait at that point in time. And an interesting point, and we don't have a specific slide on this, but obviously one of the big questions that's still out there is, okay, the CARES Act said this debt forgiveness is not taxable income. Congress does not intend for that to be taxable income. Back in April, the IRS came out and said, okay, we get that, but under Section 265, expenses related to tax-free income are not deductible for income tax purposes. And so, it's interesting. There's several questions on that. The first question comes up is, hey, IRS, Congress clearly intended this not to generate taxable income. Did you overstep with this notice? Because they issued a notice. It certainly is their position at this point in time. But it's not the most powerful thing they could have done there. So they issued that notice. The second question is, okay, so I incur these costs in 2020. I've got these wages, I've got these other costs, and I'm filing my 2020 tax return, and I'm not applying for forgiveness until March of 2021. So now I have tax-free income in 2021, and the expenses I incurred in 2020. So, there's no guidance on this yet. Are those expenses really non-deductible in 2020 when I didn't have any tax-free income in 2020? Do I literally have to treat those as non-deductible, even though I haven't received forgiveness yet, and I all the facts and circumstances haven't occurred for me to receive forgiveness? That's a big unknown at this point in time. we monitor, monitor Washington closely. The AICPA monitors Washington closely, and just the end of last week, listen to the AICPA position. They still think that that when the next legislation comes out of Washington, that Congress will fix that issue. But they also think that if that doesn't come out soon, it may not come out at all. And obviously, Tom alluded to President Trump's executive order with regard to payroll taxes, employee payroll taxes, which was done, specifically after talks fell apart a couple of weeks ago in Congress with respect to, passing further legislation. So we're still expecting something there, and obviously desiring something there so that everyone has clarity. But clearly this is an odd year in terms of what may happen in Washington, and don't really think you can rely on anything there. So, all right, next polling question. Which forgiveness period do you plan to use? The 8-week period, 24-week period, something in between, or no clue? And again, we'll give you about 20 seconds or so to respond there.
And remember to hit submit. And while we're waiting for that, it does bear repeating what Paul said. The biggest unknown is the taxability factor. And in simple recap, the forgiveness will be taxable as it stands now with the IRS interpretation, but it's actually not the revenue that's taxable, it's the lack of being able to deduct the expenses. And this is one of the reasons why we're advising for organizations that can wait and see to do so, because you may have incentive to wait until 2021 to submit for forgiveness.
Correct. All right, I'm going to go ahead and move forward here and see what the responses are. So we've got about 8%, 9% looking at the 8-week period, 39% looking at the 24-week period, 17% that are going to looking at using something in between, and about 35% looks like are essentially waiting to determine that. So, and then I think with that, Tom, I'll turn it back to you here.
Any in the in-between period, the 17, 18%, that's a little higher than I was expecting. That'd be interesting to see how many are in there. But this is back to me now, isn't it?
I agree, Tom, because that essentially means probably that they are planning to apply for forgiveness relatively soon.
Yep. Okay. So as Paul mentioned, there's with the Flexibility Act, they did provide 2 new exceptions for the knockdown related to if you had a full-time equivalent reduction. So you'll remember that that's a potential knockdown on the amount that can be forgiven. They did provide these 2 exceptions. One is if you had to furlough or lay off people and then you gave them job offers and they declined. And we saw that a lot with our clients. Our clients saw that a lot, especially with lower paying jobs, both because folks were either still concerned about COVID or frankly getting more money on unemployment and not coming back.
Right.
Or you offered jobs to other people and they turned it down. Now, if you're going to lean on that, you do have to retain the documentation of the evidence that you offered the job and it was declined and that sort of thing. So you do have to retain that documentation. The other exception is if you weren't able to return to the same level of business due to government action related to COVID. And that text in orange, that was originally orange because it had some degree of uncertainty. As Paul mentioned earlier, though, that was clarified that they're going to interpret that broadly. So even though it was in Minnesota anyway, it was the governor that shut down a lot of businesses, that should be interpreted that would qualify for a safe harbor. And I'm going to pick up the pace a little bit here to make sure we've got adequate time at the end to cover some of these questions that are out there on, especially on the taxability and so forth. So this slide, the Flexibility Act, this was a biggie. It decreased the floor required for payroll from 75% to 60%. Now, for a lot of organizations that are going 24 weeks, you may very well have 100% of pay. You might be able to cover the whole thing with payroll costs. And we get that question a lot. Well, if we have enough payroll, should we just do that, not count for the other stuff? And the answer is yes, it's easier. Just do the payroll then, if you have enough. Now, you still want to capture the other data just in case. That would be my recommendation. But there's no reason to have to submit non-payroll costs if you have 100%. The last bullet there, this was an issue a while back. There was, the way it was written, it could have been interpreted that it was an all or nothing, and that if your payroll wasn't at least 60%, that you would get nothing. And that did get clarified that it is proportional. So it's not an all or nothing event there. The employer payroll tax deferral, that changed under the Flexibility Act. And this was a nice change. Now, don't confuse this with the recent President executive order on employee possible deferrals. This is the employer share of Social Security that you've been allowed to defer since back in late March. And the Flexibility Act extended the deferral period through December 31st for everybody. And this is an interest-free loan, is what it is. You do have to pay it back, but there's no interest on it. 50% gets repaid in 12/31/21 and the other in 2022. We fielded a lot of questions from clients on the recent executive order on the employee possible deferral. My understanding is that payroll companies across the board and everyone else that I've heard are telling everyone until further notice, continue withholding on that. That's beyond our presentation here, but I mention it only because we've had so many comments on it. There is here in the presentation, this is just a grid of what we've been talking about already. Nothing new here. The column to the far right, the PPP FA, that's the Flexibility Act. So that is what's current, and pretty much across the board, that was all good news. It was all favorable information that moved forward. So a couple other new things, or possibly not new, but if you're a not-for-profit, or maybe you sit on the board of a not-for-profit, there are some unique things here. One is, and this is a big one for a lot of not-for-profits, the feds via the OMB clarified there is to be no double dipping with other federal programs. So if you have other federal grants for which you're requesting reimbursement for payroll costs and so forth, you cannot apply those same costs for forgiveness to the PPP, or vice versa. What's uncertain, or maybe less certain, is what that means for similar state, county, or other governmental programs. I'm not aware that there's any blanket rulings out there or anything like the feds made. Our advice has been generally most government grants have restrictions on double dipping. And I would be very cautious if you're thinking of double dipping on any government grant program. That's a big one. The other one is single audit applicability. If you're with a not-for-profit, you probably know, or government even, you're probably familiar with what that is. The good news is the PPP is not subject to single audit requirements. However, if you do have the EIDL loan or some other funding, those are applicable to federal single audit. And then accounting options. So this is actually the most common question I'm currently fielding from clients right now. I think that's probably a good sign that a lot of entities are at least somewhat comfortable with other pieces. I'm going to rip through these real quick. The GAAP does not, and my answers here are under generally accepted accounting principles, or GAAP, which doesn't address it on point. But the AICPA has issued guidance, and there are 4 potential options you can choose. And I'll start with number 1 is ASC 470. That's debt, that you treat it like other debt. That's the suggested default. That's my suggestion, at least. I know many others do too, but that's my suggestion, to start there. That's your starting point. In that option, you do not recognize revenue until the forgiveness is approved. So that's the simplest from an accounting standpoint. Keep in mind, this doesn't have anything to do with tax, at least not directly. That's the simplest because you don't have to do a bunch of accounting in the meantime. You just wait till forgiveness, and then you take that to revenue. Technically, the revenue is a gain on extinguishment, but more on that later. Also, technically, you would accrue interest on it because remember, interest is deferred, but it is accruing. Technically, you would accrue it during that period, and then at the forgiveness time, that gets forgiven then as well, and you'd recognize revenue. I know for a lot of entities, the interest at 1% would be immaterial, and may choose to not record it at all, at least not on a month-to-month basis. This is
Tom, just to jump in quick there, the one comment I would make with respect to tax there is, if we don't get any further guidance, and I'm, considering my possibilities of, recognizing the tax-free income in 2021 with respect to expenses from 2020, and trying to get myself in a position where I don't have to add back those expenses in 2020. This is likely what I would like to do for book as well, so that I'm consistent from tax to book or book to tax, whichever way you want to look at it, in not recognizing that income until the forgiveness actually happens.
I agree, Paul, and that's an important point. I had mentioned this does not directly impact tax, but there could be an indirect, and that is if you wait for tax until 2021 for forgiveness, and you take a tax position one way, but your GAAP financials take another position. That's not necessarily wrong, but it could be an argument against you if that was scrutinized later on. So that's one option. Now, the other, what I think is going to be the most common option is ASC 958 conditional contributions. Now, that is not for profit specific GAAP. But in this case, they say it's acceptable for for-profits as well. So if you're a for-profit and boy, you always wanted to follow this accounting, here's your chance. But essentially what it means is you recognize the revenue over time, generally as you incur the eligible expenses, but not quite that simple. What the GAAP guidance here says is you record revenue as all the conditions are lifted. So generally speaking, it's while you incur the eligible expenses. But if you had FTE or wage reductions and have to rely on the safe harbor for bringing people back, technically that condition isn't lifted until you've actually done it. Also, if you're a June 30 or maybe other year end that overlaps the period of the covered period, or rather if the covered period overlaps your year end, it could get kind of hard to get a precise calculation there, and you'd probably need to estimate. But the takeaway is you can recognize revenue sooner. And so you do have some strategic options. Do you want your books to take the hit or the bigger hit during the COVID period, or do you want it to be later? So those are some considerations. These two are going to be the most common methods. There's two other options. ASC 450 is a gain contingency. I I don't see much reason to follow this. It's very similar to the debt option. And in some cases, there was some discussion that is questionable whether that's even legit, but that's enough said on there. If you're considering that, I think it'd be easier just to do the debt. The last one is international standards, IFRS. And they did clarify that this would be acceptable. And I should mention, sorry, I forgot to mention, items 3 and 4 are only allowed for for-profit entities. Not-for-profits cannot select those. So options 3 and 4, or excuse me, option 4, the international standard, that's similar to the conditional contribution recording, so you're going to recognize revenue sooner. And this is the only option that allows you to net the forgiveness with the expense. So in other words, it wouldn't be a revenue, you'd have less expenses. I haven't seen an example yet where I'd recommend doing that, because I think by netting out legitimate expenses, I think it is more likely to skew your financials, but ultimately that's something you could consider. Now, from a practical standpoint, regardless of which option you take, I'm telling clients, keep your accounting simple. When you get the loan, put it on as a liability and call it PPP loan payable. When you recognize revenue under any method, what I'm advising is give it its own line item and call it PPP loan forgiveness. The reason being is keep it simple. Everybody knows what the PPP is, or I mean, presumably anyone reading your financial statements are going to be familiar with it. And regardless of which accounting method, whether it's technically a gain on extinguishment or a conditional grant, you can disclose that in the footnotes. So keep it simple there. And we're having so much fun here. I see we're running short on time, so I'm going to rip forward here. Our last polling question, have you thoroughly documented your economic uncertainty? We haven't talked about that yet. We're going to, so this is going to lead into it. This is what gave you cause to apply for the loan in the first place. What was your economic uncertainty?
Yeah, and I think, Tom, the important thing to point out here is, when you applied for the loan, you attested to the fact that you had economic uncertainty, and that was the reason you needed to apply for the loan. When you apply for forgiveness, you are going to repeat that attestation. But it's important to point out that it's still an attestation as to, that point in time back when you took out the loan, not the point in time when you're applying for forgiveness. And, one of the things that can certainly come up there is, okay, hey, at the time I applied for the loan, I just sent all my employees home. I didn't know, maybe I'm a construction contractor. I didn't know what job sites were going to get shut down. I had no idea. The only thing I knew for sure was I was scared to death, right, that I was going to lose my business. For a lot of reasons, right? And so you say, I definitely had uncertainty then. Now the thing is, okay, I'm gonna apply for forgiveness, and I'm going to attest to the fact that I had that uncertainty. And in 99% of the cases, I think that's going to be true. But now you look and you say, okay, but when I'm applying for forgiveness, the SBA has the benefit of hindsight, right? They can look back and go, you didn't do that bad over this period. Or worse yet, they have a several year period where they could come back and audit you and audit whether you had that economic uncertainty or not. So now, take my construction contractor example and, wow, yeah, we didn't have a great 2020, but you know what, things came back and we killed it in 2021 and 2022. We all know construction is one of those cyclical businesses, right? Now the SBA has the hindsight of 20, or the benefit of that hindsight, that 2020 hindsight. And so you really want to make sure that right now while it's still all fresh, you're documenting, what that uncertainty is. You're putting that file together. So if somebody comes looking for it, you've got it.
Yeah, and that's huge. And the polling results, frankly, are a little concerning to me. I'm actually surprised and a little concerned. We've got 72% have not thoroughly documented your economic uncertainty. And again, as Paul mentioned, it was as of the time you applied at the loan, not today. It's at the time you applied for the loan. And the other unknown there is what or how the SBA may interpret that with the benefit of hindsight. So if you haven't done that yet, that would be your number one thing to get started on, is documenting that. And by documenting, it can be a memo, and keep it in your file as to what gave rise to that. Paul, we've run kind of late here. I'd suggest at this point, if you want to do your quick recap, and maybe we have time for a couple questions.
Yeah. Yep. I just want to, kind of recap, what those unknowns are. But I would say, Tom, I'm maybe a little concerned, but certainly not surprised that, that number of people have not yet documented their files. One thing I would tell you is whatever industry you're in, go to your industry organizations. I can tell you the AGC of America has a big file that you can pull off their website, documenting all kinds of stories, giving rise to uncertainty for construction contractors throughout the country. And my guess is a lot of other organizations do as well. So that's a big question, right? How the SBA will look at that economic necessity. Will there be additional tax guidance? Will there be additional PPP funding or some other program is unknown. And then, how will the FTE reductions be handled if I'm applying for forgiveness, before the end of the covered period? That's still an unknown there. And in terms of what to do now, I think the last thing we hit is a big one, right? Document your economic uncertainty. Identify and accumulate what your eligible forgiveness expenses, are, right? And get a system in place to gather those, determine what your wage and salary or FTE reductions are, or how you meet exceptions and won't need to have reductions, and then monitor future developments is really the next item. Leads back into the what don't we know question. So I'm trying to look on these questions here. I think we have hit all these. Can I apply for more money under the current PPP? No. Will there be an additional program coming out is certainly a question. If there's another PPP type program which has been in some of the proposed legislation, I think it will be a lot more narrow and targeted to specific industries that have been hit really hard. Otherwise, I think we've hit those questions. Looks like we have a couple of minutes left. Michelle, are there any questions you want to that are on the Q&A that we should hit?
Sure. We have one question that we have time to go over for. And the question is, if employees quit during the loan period, does that count as a reduction?
Well, it is a reduction, but you should be able to exclude that. If they voluntarily left for some reason, you just need to document that. And Tom alluded that actually on one of his slides, right? That they voluntarily left,
because I don't think we mentioned that. That's a great question, because that was one of the exceptions too. If someone left voluntarily or were terminated for cause, those also do not count against you. It was only if you had to furlough or lay someone off that you had the otherwise need the safe harbor.
Great. Well, do you have any final thoughts you'd like to leave us with?
Well, I think the you know the big thing I would say is, you know, make sure you document your uncertainty, because that's the biggest issue. You know, start going through your calculations. As we mentioned several times, I think most companies, in terms of incurring the expenses, should be able to receive, if not full forgiveness, near full forgiveness. And so then, if I know that, then my big question after that is to make sure I document my uncertainty, so I'm bulletproof with the SBA.
And if we didn't answer anyone's questions, if we didn't have time, and they weren't otherwise answered, please do reach out to us. We'd be happy to have follow-up conversation. And I understand our presentation is going to be made available as well.
Right.
Yes, and your contact information is right here on the screen. So if anyone has any additional questions, please feel free to reach out. Thank you so much, gentlemen, for speaking today. This marks the end of our webinar. Thank you for joining us today. We look forward to you joining us on future webinars. You can find information about upcoming webinars in the resources widget. Don't forget to download your CPE certificate in the certification widget. Your CPE certificate will be available to download in the thank you for attending email that will be sent within the next 24 hours. If you have any questions regarding CPE credits, please feel free to email conf@financialexecutives.org. Have a wonderful day, and again, thank you to our speakers for today's webinar.
All right.